If your bank charges you every month just to hold your money, here are 5 fees you can stop paying and one rule that decides whether you pay anything at all. $17.95 a month, one of the big 5 charges that much for a standard checking account. The same fee costs $215 a year before you buy a single thing. Meet Katerina. Katerina is 34 and works in Winnipeg. She opened her account 9 years ago and has not thought about it since. She is careful with money. She has never been overdrawn. She has paid a monthly fee on that account every month for 9 years, and it has gone up more than once in that time without her ever deciding anything. Her colleague Liam, same bank, same building, pays nothing. He did not switch banks. He did not get a special deal. He does not even have more money than she does. He just knew something Katerina did not. And here is the part that should bother you. In 9 years, nobody has ever called Katerina to mention that a cheaper account exists, not because anyone did anything wrong, but because the fee is not an accident. The fee is a setting, and nobody is obliged to tell you the setting is there. So, in order, first, the rule that decides whether you pay that fee at all, then the cheap account your bank has committed to offering you, the one almost nobody asks for, then the 4 smaller fees, quickly, and last, what all 5 big banks charge right now, side by side with the no fee options, no affiliate links, no sponsors, nothing for sale, just the numbers. Every one of those monthly fees can be brought to zero. The bank tells you how openly keep a minimum balance in the account, and the fee disappears. $4,000 on the middle tier, $6,000 on the top one, $3,000 on the smaller plan. That sounds simple. Keep $4,000 in the account. Pay nothing. Except that is not the rule. It is not your average balance. It is your minimum daily balance. Every single day of the month. TD uses that exact phrase on its own website. Minimum daily account balance. Not average, daily. So, take Katerina's month. She keeps $6,000 in that account, comfortably above the $4,000 she needs. Rent leaves on the 1st. Her pay lands on the 2nd. For one afternoon, her balance sits at $3,900. One afternoon. Out of 30 days, she pays the full monthly fee. Nothing is prorated, nothing is partial. The 29 good days do not count. $100 short for a few hours costs her $17.95. And here is the second thing nobody mentions. Those thresholds have moved. Scotiabank's power checking account went from a $1,000 minimum to $2,000. CIBC's everyday checking did exactly the same. That is double the money for the same waiver on the same account. So if you set that account up years ago, cleared the minimum easily, and now you are somehow paying a fee. You did not fail to keep up. The bar moved, and to be completely fair to the banks here, they did tell her. They have to. Under the Bank Act, a bank must give you written notice at least 30 days before it raises a fee or changes the terms on your account. So somewhere in the last 9 years, a notice went out, a letter, a page in an envelope, a line on the back of a statement. That is disclosure. It is not the same thing as knowing. Now, some of you are already thinking the obvious thing. I do not have $4,000 sitting spare. That rule is not even available to me. Hold that thought, because it is the right thought, and the answer is coming in about 90 seconds. But first, say Katerina does everything the bank asks. She keeps $4,000 in that account every single day of the month. She never slips. The fee is waived. She pays nothing, except that $4,000 has a cost of its own. A checking account pays no interest, none. So her money sits there all year and does nothing. Put that same $4,000 in a savings account. At 4%, it earns about $160 in a year. So yes, she avoided the fee, but leaving the money there to do it cost her $160 she never earned. So Katerina had 3 choices, not 2, she could pay the fee. That is $215 gone. She could leave $4,000 sitting in the account instead, no fee, but no interest either. Or she could move to an account with no fee at all and put that same $4,000 somewhere it earns, no fee, and about $160 back. Worst choice to best choice, that is a gap of $375 a year. Same person, same $4,000. The only thing that changes is where it sits. Now, back to that thought. What if you do not have $4,000 to park? Here is the part almost nobody knows, and it is not a negotiation. Since the 1st of December 2025, 14 financial institutions in Canada, including all 6 of the largest banks, have signed a commitment overseen by the Financial Consumer Agency of Canada. Under it, Canadians can get a basic checking account for no more than $4 a month. Not a promotion, not a limited time offer, a standing commitment, and the agency monitors whether they keep it. And it cannot be a stripped out account. At least 18 debit transactions a month. That is 50% more than the old rule. And those count Interac e-transfers, bill payments, debit purchases, and cash withdrawals. Check writing included, and $4 is simply the price. You do not have to keep a minimum balance to get it. No $4,000 sitting still, no daily balance rule, no one bad afternoon. Your bank almost certainly offers a version of this. TDs is $3.95 a month, and for some people, that same account costs nothing at all, $0. If you are a young person, if you are a student, if you are a senior receiving the guaranteed income supplement, if you are the beneficiary of a registered disability savings plan, and since December, if you are new to Canada, your first year is free. Then there is one more layer, and this is the part that changes from bank to bank. Each signatory also has to choose at least one more group to give a free account to. The options are Indigenous peoples, people receiving social assistance from certain provincial or territorial programs, or people who receive the disability tax credit, and their supporting family member. Each bank picks its own, which means the answer genuinely depends on where you bank, and the only way to find out is to ask. So look at those two numbers side by side. Katerina pays $17.95 a month. The same bank in the same branch offers an account at $3.95 with no minimum balance, and for some people at $0. The difference between those two accounts for her is $168 a year. 9 years in, nobody has asked Katerina a single one of these questions, and none of this needs a difficult conversation. You are not asking for a favor, you are asking one question. Which accounts do I qualify for, and what is the fee on each one? 4 minutes, one question. Right, 4 more quickly, because these ones are smaller and they add up fast. Paper statements, a few dollars a month to print something and post it to you. $30 to $40 a year. If you genuinely use them, keep them. That is a fair trade. But if they go from the mailbox to the recycling unopened 12 times a year, that is a setting in your app under Documents or Communication Preferences. Under a minute to change the other bank's machine, this one charges you twice, and almost nobody realizes it. The machine itself adds a convenience fee, often around $3. That fee is not your bank's. Then your own bank charges you separately for going outside its network. Scotiabank spells this out on its own fee page. The preferred package includes one free withdrawal from another bank's machine in Canada each month. After that, $2 every time, $3 if it is a Visa or Plus machine, $5 outside Canada. And Scotiabank says it plainly in their own words, you may still be charged a convenience fee by the other bank and machine operator, not by them. So a $20 withdrawal from the wrong machine can cost $5. 25% of what you took out twice a month, and that is around $100 a year to reach your own money. The foreign fee on your debit card. Most people know credit cards add a charge on foreign spending. Far fewer know the debit card does too. TD publishes it, 3.5% added to foreign cash withdrawals after the amount has already been converted into Canadian dollars. Read that order again. The conversion happens first, the percentage goes on top, $400 of currency on a trip, and that is $14, 3 times on a 2-week holiday, and you have paid $42 to use your own money abroad, plus whatever the machine charged, overdraft protection at TD $5 a month, plus 21% annual interest on whatever you actually go below zero, 2 separate things. The $5 is a subscription charged whether or not you ever use it. The 21% only applies if you do. So one question, in the last 6 months, how many times did your account actually go below zero? If the answer is none, that is $60 a year for insurance you have never claimed. And if the answer is often, keep it. It is cheaper than a bounce payment. This is not a trick. It is insurance. Good value for the people who need it. Poor value for the people who do not, and almost nobody reviews it after the day they signed up. Now here's the question underneath all of this. None of these fees are hidden. Every single one is published. Katerina could have found all of it in 20 minutes, any day for 9 years. So why didn't she? Because $17.95 is exactly the right size. It is small enough that it never reaches the top of anyone's list. It is not a crisis. It never ruins a month. It is annoying for about 4 seconds when you notice it on a statement, and then something more urgent happens, and it waits until next time and next time for 9 years. That is the design. Not a trick, not a con, a number chosen to sit just below the level where a busy person does something about it. A fee big enough to matter to the bank and small enough not to matter to you on any particular Tuesday. Which is why the fix is never really about the money. It is about doing the 4-minute thing once on a day when it is not urgent, because it is never going to become urgent on its own. And I know what some of you are thinking, fine, a few $100s a year, that is not life-changing. You are right, on its own it is not. So let's do what the bank does and look at it over time. Katerina has paid that monthly fee for 9 years. Call it 10 to keep the numbers clean. $215 a year for 10 years is $2,150. Now, the other side, if that $4,000 had been sitting in an account earning 4% instead of nothing, after 10 years, with the interest compounding, it would have grown by about $1,900. So put the two together, $2,150 paid out, $1,900 not earned. The gap between the version of Katerina who never asked and the version who asked once is just over $4,000, which is almost exactly the $4,000 the bank asked her to keep in the account in the first place. So here is the whole board in one place. At the big five, the standard checking tiers land in 3 bands. The entry accounts run around $3.95 to $4 a month with a limited number of transactions, usually about 12. The middle tier, the one most people are actually on, runs from $11.95 to $17.95. Waived at a $3,000 or $4,000 the minimum daily balance. The top tier runs around $30.95. Waived at $5,000 or $6,000. TDs unlimited is $17.95. Waived at $4,000. Its everyday account is $11.95. Waived at $3,000. BMO's performance account is $17.95 at $4,000. Scotiabank's preferred package is $16.95 at $4,000. CIBC's smart account is $16.95 at $4,000. They are essentially the same product at the same price. And then there is the other column, the online ones. No branches to walk into. You do everything on your phone or on your computer. EQBank, Simply, Tangerine, all 3 are real banks, and all 3 are owned by names you already know. Simply is part of CIBC. Tangerine is part of Scotiabank. EQBank is part of Equitable Bank. No monthly fee at all, no minimum balance, unlimited transactions, and one honest warning, because you will see this claim made badly all over the internet. These accounts do not pay you much interest. Tangerine's checking pays about 0.1%. Simply I's is lower still. EQ Bank is the exception, and it pays more if your pay goes in there directly. So interest is not the reason to move. The reason to move is that you stop paying the monthly fee and you stop having to leave $4,000 sitting still. That $4,000 can go into a savings account instead. That is where the few percent actually lives. You will also see Wealthsimple, Neo, and Coho on lists like this. Worth knowing what they are. Those are not banks, they are financial technology companies, and your money sits at a partner bank behind the scenes. The protection is real, but it is worth knowing whose name is actually holding your deposit now. The two objections, because they are both real. Are they safe? Yes. EQ Bank, Simply I, and Tangerine are all members of the Canada Deposit Insurance Corporation. The same protection that covers the Big Five up to $100,000 per eligible category. Same protection, same limits. That is not a marketing claim. It is how the system is built. Is switching a hassle? Sometimes, and this is where people get stuck. The direct deposit, the pre-authorized payments, the bills. So here is the honest middle path. And it is what most people actually do. You do not have to move everything. Leave the account where your mortgage and your history sit. Open a no-fee account alongside it. Move the day-to-day banking across and let the balance that used to be a hostage go somewhere it earns. And if you would rather not move, that is fine. Many people stay with their bank for good reasons. Then just ask. Ask your bank which accounts you can have and what each one costs. Both choices work. What matters is that you made one. Most people never did. They opened an account years ago and it has been charging them ever since. So 5 fees, the monthly fee and the daily balance rule that decides it, paper statements, the other bank's machine, the foreign fee on your debit card, and protection you may never use. For a lot of Canadians, that is comfortably over $400 a year. Over a decade with what the money could have earned, it is thousands. And here is the rethink. None of that was a price. Every single one was a setting, a default chosen once, running quietly ever since, in a system where nobody is obliged to tell you the setting is there. That is the thing worth taking away, not the 5 fees, the idea underneath them. In Canadian banking, the expensive option is almost always the automatic one. The cheaper one almost always requires you to ask. And that is what this channel does. Every week, one thing you were told about money in Canada, that turns out to work differently than you thought. Not what to buy, how it actually works. Nothing is sold here, so nothing has to be spun next week. Rewards points, specifically what your grocery card actually pays you once you count what you had to spend to earn it. The number is smaller than the advertising suggests, and the gap is wider than most people would guess. See you next Wednesday.